Hello everyone, this is Tom Fox and I would like to welcome you to episode 94 of the FCPA Compliance and Ethics Report. In today's episode, I continue my conversation with internal controls expert Henry Mixon on part 2 of internal controls for gifts, travel, and entertainment under a best practices compliance program. I hope you were able to listen to part 1 and that you will enjoy part 2. If you have any questions, please give me a shout at tfox@tfoxlaw.com. Thank you very much.
We are live. Hello, everyone. This is Tom Fox, and I would like to welcome you to this episode of the FCPA Compliance and Ethics Report. Today, we are on part 2 of a 2-part podcast on internal controls around gifts, entertainment, and hospitality and travel in your FCPA Compliance and Ethics program. In part 1 of this 2-part program, I visited with Henry over the area of gifts, and I asked him if he could maybe give some of his thoughts on entertainment, travel, business hospitalities, etc. So he was gracious enough to come back on and take a little more time to help me understand this. So, Henry, thank you very much.
It's a pleasure being here.
In our first part of this program, you described controls regarding employee expense reporting over gifts, but what are some of the other areas a compliance officer should be concerned about other than specifically gifts?
Well, I think, within any company, there will generally be ways in which a gift can be given or paid for or money can exchange hands other than employee expense reports. And so it's important to first and foremost have reasonable control over expense reports because it's clearly known that that is a risk. But I think there are several other areas, and in a given company there could be more, where the controls should specifically focus on the possibility that gifts can be part of or processed through that system. The first one, of course, is company checks and wire transfers, which are in response to check requests or purchase orders or vendor invoices that have been submitted. We talked about that some in the general internal controls broadcast, and we also talked about it in the third-party broadcast, but we don't want to lose sight of the fact that in addition to some of the other improprieties that can go through the cash disbursement process, there can be gifts and payments to employees in lump sum amounts without clear business purpose. Now, in this area, in many companies, the accounting systems allow electronic controls to identify and flag some of those items. And we talked about the vendor master file, and basically in one of the earlier broadcasts, in order to get a check dispersed in most companies, information has to be in the vendor master file to support that disbursement. And so if you control that vendor master file, you can provide controls to minimize your risk that gifts and proper entertainment, third-party travel go through the disbursement system. Now, another major area for gifts would be checks drawn on local bank accounts in location outside the United States or off-books bank accounts, commonly known as slush funds, petty cash disbursements. There are a number of areas that are unique, present a unique risk regarding activities outside the U.S., and we'll talk about those in our next broadcast, but I just wanted to mention that as part of this list of considerations. Now, one of the big areas, of course, is travel for government employees and their relatives. So I think it's important to look at how the corporate travel department and how independent travel agencies are reimbursed or paid for travel. There can be an internal abuse of power to tell the corporate travel department, buy a plane ticket for this government official and his 6 relatives to go to Las Vegas, book the hotel, pay for it all with company money, without any of that being documented as to business purpose. I think it's relatively common in large companies, corporate travel, perhaps we use a corporate Amex to pay for all the travel, and then somebody just writes a check to American Express without oftentimes a lot of review of those details. So you need to look at that and focus on that risk. And in the independent travel agencies are the same risk because they can involve collusion with employees who are trying to give inappropriate gifts or travel. And so those two travel areas outside of the accounting function certainly need some attention. And then number 4 is one of my favorites, and that is procurement cards or P cards. If your company uses these, it is a very high risk, not just for FCPA, but for fraud generally. It's a great selling job by banks for cash management, but in almost every instance where I've seen P cards used, there is little, if any, control over paying those statements or requiring receipts to be submitted showing proper business purpose. I did one fraud investigation a couple of years ago of a VP purchasing of a public company who used the entire annual limit, which in this case was $50,000, for personal expenses for many years, and nobody detected it until that person got in trouble for some other impropriety. So if you have P cards, try to keep them out of your international operation as much as possible. Then you, of course, have combination. You can have a sightseeing trip plus pocket money. So any way somebody can get currency in your company is something to consider the risk. Charitable donations, a favorite charity of a government official, political organization. The list really could go on and on. I don't want to forget corporate credit cards, one of the biggest abuses. I've done many fraud investigations where people have used the corporate credit card for improper purposes and then compounded the situation by using the receipt from the corporate credit card and getting reimbursed on the expense report. So another good way for an employee to get cash, whether they're going to pay a bribe with it or just use it for personal benefit, doesn't really matter. It's the cost of the company.
Let me stop you there, Henry, because you really brought together there's several concepts I've heard you talk about throughout this series, and I just want to see if I've got these straight. And let me start with, I've often heard you say that you need to think like or how a criminal might think to try to stop some of these. But the list you just went through, and indeed your recitation in part 1 of this program on gifts seems to me to be really just basic good financial controls.
Well, they are basic good financial controls. I think within that system, the question still remains, if I wanted to pay a bribe, how could I do it? If I wanted to commit fraud, how could I do it? So that kind of helps in designing what kind of controls and how much review you need. For example, if a local bank account in a foreign country only has signers in the U.S. And only has local receipts from sales and no transfers in the U.S., you get a different risk pool, a much less likelihood that a perpetrator could get his or her hands on some money inappropriately. But if you think, well, if that local account, if the check can be signed only by the country manager, then that's a good way for the country manager to get cash to pay a bribe. So that's where you need to have a control. And it's kind of a combination. I mean, you need good, solid, sound business controls, and these are not unique to FCPA. They just happen to serve a similar purpose for identified FCPA risk. But fraud generally is perpetrated by people who think a different way than most business people. And there has to be some element of thinking like a perpetrator if you're going to really design internal controls that are effective.
Well, it sounds like you're saying something along the lines of that with misbehavior like water will seek its own level, and that a fraud perpetrator or indeed an FCPA violator will either test or search until an appropriate internal control is either not present or weak. Would that be a fair assessment?
That's exactly on point. The thing to keep in mind from the top side down, that corruption and payment of bribes is one type of fraud in the workplace. And fraud in the workplace typically starts and is often represented by the fraud triangle. It first starts with a pressure, which is a financial pressure in the case of an individual who needs some money for his personal bills, or it's pressure to achieve sales goals in a foreign country, or it's pressure to hit the bonus target. Then you have a rationalization process where the employee in his own mind decides it's okay to do whatever it is he or she's planning on doing because they're not really a criminal. But then the third element comes in where you just described it, and that is the opportunity. The perpetrator has to find an opportunity situation. And what that means is some situation where the controls are so weak or so non-existent, it becomes easy to commit the fraud that way. And that means they will sometimes try 2 or 3 different ways before they find the one that's the easiest to operate in.
So you've often talked about a risk assessment. Would it be fair to say that you could move to almost a continual risk assessment, or at least some type of ongoing risk assessment to try to anticipate where people might move towards weak internal controls, or is that really necessary?
No, I think that's absolutely what you need. A risk assessment is not a one-time static process. It's very much a fluid process, and someone in a company has to be responsible for keeping it current as conditions change. For example, you and I have talked about the recent enforcement action by the SEC against Smith & Wesson. That was a situation where the company was involved in domestic sales and started a new international division which did not have any brick and mortar outside the U.S. but used third-party agents and distributors. Well, when that business decision came about, that should have triggered an immediate upgrading of the risk assessment to take into account those increased risk. We don't know whether they did that or not, but the end result was that it cost them some money because of ineffective controls. And so it is an ongoing thing and does have a lot of moving parts. But I think it's very important that there be some methodology to just periodically say, are we putting our resources where our risks are the greatest?
Henry, I'd like to go back to one of the things that you really started off our part 1 of our program on internal controls around gifts, entertainment, and hospitality with. And you said one of the most common tricks or techniques an employee might use to get around internal controls on expense reports is to split a gift or other expense into multiple parts in order to avoid a defined dollar limit or avoid a certain level of approval. How should a compliance officer think through trying to address that risk?
Well, it's an extremely common risk, not limited to expense reports, obviously, but certainly it applies. I think there's 2 areas of consideration. One, going back to my stop and think control, include an affirmative representation in the expense report and the pre-printed wording to the effect that, all items represent the entire transaction and no transactions have been split into multiple parts, for purposes of the expense report. Doesn't prevent it, but it certainly causes someone to stop and think. But the primary thing is there should be a control that says only original receipts can be used to get reimbursement, particularly on high-risk types of transactions. So this will happen. There will be missing receipts. But if someone is trying to say, gee, I lost my receipt and there's a $5,000 gift this month and a $5,000 gift next month coming in, and in both cases there's no receipt, there very well may have been a $10,000 gift paid or given, And so there needs to be a control that says if there is a missing receipt, here's what happens. And the normal control would be this has to be moved up to a higher level of approval. The first line supervisor cannot approve it.
One thing you've talked about rather consistently, unfortunately, throughout our series on internal controls, but I feel like I need to ask you again, is why can't a compliance officer rely on internal audit or audit controls which are in place regarding gifts?
Well, I don't think this can be emphasized too much. I think because I hear it almost every time I talk with a compliance officer, there is a very common belief, I think, that internal audits provide sufficient control over enforcement of the gift policy. And as valuable as internal audit is, and I was a VP of internal audit in a public company, so I don't in any way mean to say internal audit provides other than a valuable service. In this particular instance, it is a detect control that is often a year after the fact and is often limited to those locations where expense reports are material, and it simply does not have a high probability of providing any assurance that going forward the controls will be enforced and inappropriate gifts will be prevented. So it's just a fact that internal audit departments typically don't have an audit plan that includes looking at preventive controls.
And would an auditor or an internal audit function, not that they wouldn't drill down, but would they drill down to the dollar amounts at might be something less than material, or would they really cut it off with some sort of materiality amount?
Typically, the concept behind an internal audit of expense reports is to get maximum dollar coverage. It's not really designed to look at necessarily expense reports across all locations or across the high-risk locations. It's a dollar amount. If they can cover $1 million worth of expense reimbursements, that is, part of the goal. It's like so many other controls involving controls over financial reporting. It's driven by the accuracy of the financial statements in all material respects. It's not concerned with amounts that are immaterial, which could really be FCPA violations and could be indications of poor controls that could result in FCPA violations.
So the controls we've talked about over these last two programs, have you thought about, or is there a way that companies can move from, certainly you've articulated how we can move from detect to prevent, but in the prevent mode, if these controls are violated numerous times, could a company do some type of discipline or training to an employee short of termination so that they, either cheated or made mistakes on their expense report several times? Is that the kind of situation where a compliance officer would notice via a red flag and then could deliver some sort of remediation wherever that might be?
Well, I think that's exactly right. In the situations where I've worked with clients under deferred prosecution agreements, one of the policy and procedure requirements that always came from the monitor was a disciplinary policy and a process to make sure it's consistently enforced. And so you certainly need that, because in some cases, no matter how well you define the documentation requirements, you're going to have multiple violators because some people are just careless, not necessarily because they are making inappropriate disbursements, but you do need a way to make it clear that the company is serious about the expense report and all these other controls regarding gifts and entertainment, that the company is serious about enforcing those, and that needs to be, made known to all employees. When there is a disciplinary action, it needs to be known.
Henry, with your background both as head of internal audit and someone who's implemented internal controls, Do you have any thoughts on the following? If a company does not have robust internal controls, does that speak to some general type of tone at the top regarding how loose or not loose they might run their company?
Well, I think the situations I have seen where companies have not had good internal controls and have gotten in trouble for it, generally it did start with what we call the control environment, which is within a company, what is the culture regarding internal controls? And that's often referred to as the tone at the top because that's where it starts, by defining the cultural expectations. But I think the other issue is what I call the tone at the middle, which is the middle management of a company has to buy into the concept that internal controls are important, whether it be they're important to keep their job, it's important to make the financials accurate, it's important to prevent FCPA violations, whatever it is. The culture and the controlled environment needs to focus on the fact that, yes, it is worth the time to perform the controls, and you're expected to perform the controls. One of the issues that I saw in one company here in Houston that I work with under DPA was that operations management was continually pushing back on anything that looked like an improved internal control because their argument was it kept them from doing business. Well, obviously controls can slow you down if you're doing business in an inappropriate manner, but they don't necessarily slow you down if you're doing the right thing if the controls are well designed, because the control should be designed in such a way that the benefits exceed the costs, and it's therefore a worthwhile thing to do in a company.
So really, although we've focused on internal controls throughout this series of programs, they are a part of a much larger holistic approach to whatever your compliance regime might be.
Well, that's right. The internal controls are the foundation of a company. And I mean, this goes back before I really got in the fraud business. When I was audit partner on a lot of very large public companies, and it was always my theory that you cannot audit a balance sheet enough to find all the problems. If a company doesn't have good fundamental internal controls, there will likely be problems. And so I think that, the same is true in an FCPA compliance officer's world. If the control environment in a company does not embrace the concept of controls as being a good one, you won't likely have a good control environment. So the selling of the process really does start at the top. Fortunately, many compliance officers nowadays report to the chairman of the audit committee, and that's a pretty good place to start getting a little bit of help in terms of getting controls in a company. The CEO and the executive committee of the CEO need to buy in and just make it clear to people they're expected to follow the controls. Sometimes that's all it takes, just a word from the top. Yeah, find time to do the controls.
Henry, we're at the end of our time again, and I was wondering if you might be able to kind of sum up or give us a wrap up of parts 1 and 2 in terms of what you might suggest for some reasonable internal controls over gifts, and then maybe focus on some areas other than gifts that compliance officers need to be aware of.
Yeah, I think basically the key points that I wanted to drive in today are expense reports are, of course, a common way for gifts and all those other types of things for third parties to be reimbursed. And so you do need a very robust process over expense reports, and that includes a very stringent pre-approval process which has controls to make sure it's enforced. It needs appropriate expense reporting formats to highlight things that need to be sure are brought to the reviewer's attention. Documentation, you can't have too much documentation, both not only the documentation of the event, but the documentation that the reviewer actually did a review and not just initials on a form because, whether it's enforcement actions or lawsuits involving financial statements, initials are just that. They are initials, and they don't document what somebody did. And then the fourth element, of course, is the effective review and approval process, that where I think more often than not this falls down is at the review stage. Because after a couple of good reviews, things are kicked back in expense reports and reimbursement is denied, the message starts to come through loud and clear. I've got to follow the rules. And then the second...
Good point.
Yeah, you have to set the tone, that if a guy has to eat a few expenses because there's no good documentation, chances are there'll be another stop and think control before the next expense report comes in. And then the other area is don't forget things other than expense reports, because many of these are where the prevent controls can come in. Expense reports are after the fact. The expense has been incurred. If there has been a violation, it's probably occurred, but yet it's still a very important activity, because the controls around the expense reports should result in a prevent control mentality before the event occurs. That's that concept. But if you get into other areas where you're dispersing funds, using corporate credit cards, buying plane tickets and paying for hotels and rental cars, the P-card situation, controls over samples and other company inventory items, controls over petty cash, there you can build in absolute upfront prevent controls. But first you got to look at it. You have to see the risk and decide the risk is worth the control and the cost of putting in the control.
Well, Henry, I really appreciate you taking the time to visit with us here today. Once again, I'd like to end by asking you if someone wanted to contact you about further information on anything you've said. Could you provide them a contact detail?
Absolutely. You can contact me at hmixon@mixon-consulting.com.
I had a profile of Henry in my last Friday's FCPA Compliance and Ethics blog, so I hope you'll take the opportunity to look there. Henry has also guest posted several times over the last couple of years on my blog, always with lots of insights into internal controls. And, of course, this wraps up our third program in an ongoing series on internal controls. Henry, I really appreciate you taking the time to visit with us today and look forward to our next episode.
Well, it's a pleasure to be here and look forward to it as well.
Thank you very much.